Hey, welcome back to the Road to Retirement. My name is Chris Anselmo with Brookside Tax and Financial Group, and our co-hosts are Tony Marlette, who's with our organization, and Tony Shore up in is it Minnesota yet?
Not yet, but they say this week.
And by the way, somebody told us this is our 100th episode.
Yes.
So got any little banners
Unbelievable.
over there? Got little banners over there, Tony?
Yeah,
Yeah, we
I
should
can
have
create one.
Yeah.
we should have we should have party music, I
Yeah,
know.
little balloons and stuff, but
Yeah.
yeah, so
Well, at least the least we should do, let me see here, the least we should do is, celebrate.
there you go. I thought he was going to play some Commodore song or something. Celebrate. So it's that time of year again. We are in November already. Can't believe that it's gone, and I hate this time change because
Yeah.
it gets dark at 5 o'clock. So
Why didn't any politician run on that, getting
You
rid
know,
of
I thought they have before. I
actually,
thought some of them have.
actually, there's
Yeah.
a bill that passed either the House or Senate already to keep daylight savings
it
time.
did, but I don't know if it ever made it all the way
Yeah,
through.
yeah, it hasn't made it through yet, but they were going to just keep it as daylight savings time,
Yeah.
which I think is better. But
Yep.
but then it'd be really dark in the morning now. But anyhow, 100th episode, we thought we'd talk about some year-end checklist things coming up because a lot of these items we may talk about, you got to get done before December 31st. There's a few that you can get done before you file your tax return. And Tony's, there's also a deadline for open enrollments coming up, right? December
Yep.
7th, I think it is.
Yep.
Pearl Harbor Day.
Yep. December 7th is a deadline for open enrollment. And basically, if you want to change Medicare plans, you want to change Advantage plans, you want to enroll in Part B, you won't avoid a penalty necessarily. If you're late, unfortunately, but you cannot just enroll at any point in the year. You have special enrollment periods. If you left your employer, if you're off some coverage, but basically, if you want to make any changes or you missed the boat the first time around, now is the time to do it. And I'd be remiss if I didn't tell everybody to like, comment, and subscribe on our Facebook and YouTube pages as well.
Aaron will love that.
Yes,
There you go.
I did it for her.
Aaron's our marketing coordinator. So also,
You gotta plug the social media and the website, and
And
folks can go to your
ironically,
website.
yeah, they tell the guy that does no social media to plug the social media. So that's fine. I'll do it.
well, at least our message might get out on Twitter now, right? Before it
Yeah.
would be. But Tony, let me ask you. So during open enrollment, there is my understanding that there's no underwriting, so you can move plans.
Correct. Now that does not apply to Medicare supplements. So Medigaps, that does not apply to. Medigaps, you have one enrollment period in your life, and it coincides with your regular Medicare enrollment.
Okay.
You will avoid underwriting on a Medigap policy, a Medicare supplement, if you use your regular enrollment period.
So when you're
Open
turning
enrollment,
65.
yeah, or you're leaving your employer,
Right.
correct.
Okay.
And if you cannot use open enrollment to skip underwriting for a Medigap policy. So for better or for worse, you got to get the Medigap policy when you're
So
eligible.
okay. So if you had a Medicare Advantage plan and you said I didn't really like it, I want to go back to regular Medicare, they can underwrite you then.
If you said if you had a Medicare supplement and you want to go back to
No.
regular
If you had a Meta
Advantage,
Advantage plan and you said, hey, this wasn't working out for me, I want to switch and go back to regular Medicare, then they could actually underwrite you then.
absolutely. And then especially if you go on to the Medicare supplement, then you will be underwritten.
Okay, so people got to be. So it's really important to pick the right plan you think for you when you first do it, because jumping around, if you get sick and you get something like cancer or something, you might not be able to leave your plan. Right.
Absolutely. And you want to do that beforehand. We do part of what we do. We go through all your options with you.
Yeah. So open enrollment is not as open as it sounds.
It's really not. I mean, they really hype this thing, and it's just like basically you can change Advantage plans or drug plans, enroll in Part B, but you still get hammered with the penalty
Okay.
if applicable.
Okay, so new thing in Ohio this year, there is a tax credit in Ohio for something called scholarship granting organizations, and these are generally, like I think most of them are religious-based schools, Catholic schools, Baptist, whatever they are. So there's a list of them on the Ohio website. What's really cool is that if you owe any tax in Ohio, they will give you dollar for dollar, not a deduction, but a credit. So if up to $750 per individual or $1,500 for a couple. So if you give $1,500 to one of these scholarship granting organizations, Ohio will give it back to you. So, it's not a deduction. So you put $1,500, you give it to XYZ scholarship granting organization, you could take a credit against your taxes for $1,500.
Wow.
Yeah. So this is the first year they have it. So hopefully, if you need more information, call us. But there's a list of them. That, first started off with like 3 or 4 of them. There was a Catholic one, a Baptist one. Now there's several of them. There's almost every religious affiliation out there that they have schools. So it's really a dollar for dollar credit. But the caveat is you have to be paying Ohio tax. So if you don't owe anything, Ohio, a lot of retirees don't owe anything in Ohio. They're not going to get the money back. But anyone basically working can go ahead and send this money in, and you're going to get it all back. So it's kind of a nice way to fund some parochial education for the kids. And it's kind of odd. I'm like, isn't that separation of church and state? I mean, is the state of Ohio now funding all these parochial schools? But
that is weird. I find that odd that passed, or that's a law that's in place.
So it's a dollar for dollar credit. It's not, like normally on a charitable deduction, you get a deduction. You don't. So if you give $1,000 to your church, you don't get $1,000 back in taxes, right?
No.
This is actually, you give $750 to one of these organizations, you get $700.
So you get it back in the form of, say, like a tax refund, then, right?
A tax refund, right? So, but I think from what I read, you got to get it in by December 31st. Then you'll get it back in, when you file your return in March or April. But you could perennially do this, and it's not costing you anything.
So that's something people could do before the end of the year.
Right. So they could fund this before the end of the year, and they'll get the money back when they file their tax return. It's kind of cool.
Do you have to do, so it's $750, you said
$750 for an individual,
or
$1,500 for a couple.
Because we have to do that amount, or can it be less?
No, anything up to that amount. I mean, you could give more, but the most you can, the largest credit is $750. So if you gave $10,000, you're only getting $750. Or because we looked into it, because we have this little charitable fund at Catholic Charities for some local needs. It used to be for schooling, now it's for mortgages, assistance, and all that kind of stuff. But that didn't qualify because we're not granting scholarships. So this is just for granting scholarships for education. So it's kind of cool. So go to the Ohio website, and you can pick one of your charities and get your money back. So it's kind of cool. So the first year for that.
So that's part of the year-end checklist, something people might want to do, and you need to do it before the end of the year. But that makes me think of other things you can do to reduce your tax burden for the year, like maximize contributions to your 401k. Is that one?
Yeah. Go ahead, Tony.
No, I was just going to say, yes, you can. So you have increased contributions. We talked about that in a previous episode for next year. So if you're maximizing this year, don't forget also to update your deferrals to make sure that you're taking full advantage, because contribution maximums are going up for 2023.
And if you're over 50, you get a little step up. You get to put away a little bit more. I still think it's ridiculous. It's not big enough. Like the IRA limitations are, what are they, $7,000?
Yeah.
Why would they put a limitation on how much you can put in? I don't understand.
It's just silly, because I mean, there's like, if you save $7,000 a year every year for your whole working life, you're still not going to have enough to retire. So
no,
I think they should raise it somehow, but that's a whole nother political discussion.
Yeah.
But
so with 401ks, you want to maximize your contributions, look at what you're giving. But that leads me to asking, this is something you guys have talked about before, is you've talked about the importance of the match. Like if your company offers a match up to 3% or up to 6%, and you put in 6%, you can, if they
Right.
offer a
It's
dollar
free.
for dollar
Yeah.
match, you can double your money, and
Yeah,
it's free
yeah,
money.
it's free money. Ours is a 3% match, so it's the employer kicks in the match. The other thing you may want to think about is tax rates are an all-time low. So if you have the ability, maybe you fund a 401k Roth.
Roth conversions and
Yeah,
Roth IRAs, that's
yeah,
another year-end checklist
yeah.
item to do
Because
before the end of
I
the
mean,
year, right?
you won't get the deduction, but since the tax rates are so low right now, like if you put away $100 and you're in the 20% tax bracket, you're only getting $20 back, right? But if you do use the Roth versions of it, not everybody has 401k Roths, but if you have a Roth version of it, you put in $100, you don't get a deduction. But when you
it's
take it out, it's tax free,
yeah.
forever.
And the
So
growth is tax-free.
the
The
growth is
difference
tax free,
is
right?
a traditional 401k and IRA, when you pull the money out in retirement, you're going to have to pay taxes on all that growth that happened over the
So
years, right?
most likely, like these are the lowest. I've been doing this since 1984. So when I got out of college, so I worked for
It's the year I graduated high school.
yeah,
So.
I worked for the big.
I was 5.
Yeah, I worked for the big 8 accounting firms, right? I was an accounting major. These are the lowest tax rates I've ever seen in my career. So you're
Wow.
not getting that big of a bang for the buck
Sure.
to fund the regular IRA or 401k. So if you have the opportunity to get it into a Roth, most likely the tax rates are going to be higher when you take it out.
One interesting drawback, I think, to a Roth conversion this year is going to be people getting a big tax bill next year and seeing their account value go down. So if you did a Roth conversion in June
Yeah.
on, say, $200,000, you're paying taxes on whatever that amount is, $200,000 that you converted. And if your account value is down to 150, you're still paying the taxes on a lower amount. So
correct. Because I think they did away with you being able to recharacterize it, or undo that. So
to undo it.
Yeah. So because it was just, obviously it was an administrative nightmare for the IRS to figure. Like Tony, you take the money out in June, and you go to pay the tax in December, and you figure, well, that 200,000 is all worth 150. I'm going to put it back because I don't want to pay tax on 200 when my account's only worth 150. I mean, how do they track all that stuff, right?
Yeah.
So they so now whenever you take it out, you have to pay the tax on what actually
What you
basically
converted.
whatever rolled over, right? So even if your account went down. So it's really important to, you got to put money away for the future, because you can't bank on living off Social Security. One, it's just not enough money. One, who knows it's going to be here? I think it'll be here, but everyone on their paychecks funding Social Security, so I think it'll be here. But 30,000. I think some of the max that I see on Social Security is maybe 35,000, around there, maybe 40. But if that's all you have in retirement, that's going to be a tough retirement.
And if they admitted on the website, we've talked about this before too, 2035 is going to start a reduction. So it's fully funded. I don't think there's nobody that's alive right now that is probably not going to ever get a penny from Social Security. But the point is 2035, they'll tell you right on the website, we cannot guarantee full payments that date or later as it sits right now.
Part of it is we're having less children. So there's less people in the workforce putting money into that system, where, generations ago, you used to have 3, 4, 5, 6, 8 kids.
Right.
We had 2. There's a lot of people don't want to have kids, and
they get started, frankly, later in life too.
Yeah. Congratulations, Tony.
Thank you.
His wife is that's okay
Oh,
if we say it.
First. Yep, you're all right. Yep.
You're
Good to
expecting?
go.
Yeah,
Yes, we
he's
are.
expecting.
Are you eating for 2? Because I'm not expecting, but I am eating.
He does eat for 2.
I am eating for 2 right now.
I have noticed that when we have dinner, she'll be in the mood for something, and then once it's like, out on the table and you can kind of like smell it and everything, she's just not down for it. So I have found myself picking off of her plate.
There you go.
So I guess I am.
You have no deal. He has no idea about the moods yet. So as they get further into the pregnancy,
it'll happen.
But that's fantastic. But we are having less kids, and that affects Social Security. It also affects the labor force. I was talking to my son not too long ago about that. He's 25, and I'm like, look, if your generation doesn't have kids or less kids, when you're 45 and you need people to work for you, there's not going to be any. So you get, and I don't want to say it selfishly, but your generation has to have kids, so there's a workforce, right? So because somebody
And
has to do
people
it, right?
and people to take care of you later on in life if you're not
Right.
able to.
Yeah. So my son already told me he's hiring that out. So
That's funny.
it's funny. I wrote his last check to pay off his student loan, and
Oh boy.
it was a pretty good number.
Yeah.
And I said, I hope you remember this when I'm 90 years old and you're taking care of me. He goes, I'm hiring that out.
Oh, oh no.
That's okay. But yeah, it's all good. So
That's funny.
other year-end stuff to get done. Now with IRAs, you actually can wait until April 15th.
Right.
So
So you can make those
Oh.
retroactive contributions until
Really?
tax
so
day.
you can sometimes
Unlike a 401k, right?
right. So sometimes we
Right.
do we do their tax return, and we said, hey, look, if you throw $5,000 in an IRA, it's going to save you, I don't know, $1,500. They're like, okay, all right, I can do that. If you have the money, first of all, you got to have the money laying around, right? So, so they give you until April 15th. Now, if you're self-employed and you have like a SEP plan, you could actually take it all the way out to, if you extend your return all the way out to October. And I think they do that because oftentimes the self-employed, they don't know, what their final number is because they're still, gathering. They don't have it all done by April 15th. So they allow the self-employed people to push it out to October. But for the rest of the world, IRAs are April 15th. So it's worth it if you especially if you're in a 20, 25, 30% tax bracket. You throw $1,000 in, they give you $300 back. So, but I would look more and more to funding Roths because the tax rates are.
Yeah. And I mean, if you need the tax break now, like you said, tax brackets are as low as they've been. You might want to think about taking the tax break in the future, which is funding the Roth.
Yeah, I mean the whole concept of that IRA was, well, we're gonna take the deduction now in our earning years. That's probably going to be our highest tax bracket, and then when we retire, in theory, you should be in a lower tax bracket. But I'm not sure that's going to happen because I think tax rates will go up. So, they're pretty low right now.
Yeah. What about?
I can't hear Tony Shore.
Yeah, taxes are on sale, right?
Yeah, they are on sale.
Yeah.
So it's a four-letter word, sale. Don't let them. So is the word. So is the word mall, right?
Right.
What can people do for their taxes for the end of the year? I mean, not like for actual tax prep, getting stuff ready. There's nothing yet. People start looking for forms, but you're not going to have any of that until end of January, early February.
Correct, because all the institutions have until January 31st to get them out. A lot of them don't, and I never see anybody get penalized. So you probably won't have all your forms January 31st, maybe the first couple weeks of February. So even in our office, we don't even start doing tax returns until February 1st because inevitably Tony Shore comes in, we do his tax return in January, and then a week later, I got another 1099. So then we have to amend it, and it's just a hassle. So,
but there are things people can do this year that need to be done before the end of the year if they want to affect their taxes, like charitable donations.
Yeah. So charitable donations, there's two ways, regular just giving money to the charity. There's also something called a qualified charitable deduction. So if you're, I think you have to be this is really screwy. You have to be 72 to do it. So, I mean, why? But anyhow, so you could take money directly from it has to be an IRA. It can't come from your 401k or any type of employer plan. So you could take money directly from your IRA and give it to a charity. And then you don't pay tax on the money you took out of the IRA. You don't get the deduction, but so if you took out $30,000 out of your IRA and you gave 5,000 of it to the charity, then you only have to pay tax on 25,000.
And it's
And
got to go, important distinction, it has to go directly to the charity.
Right. It
It
can't come
cannot
from
go
you.
to you first and then you give
Right.
it to the charity. It's got to go from your IRA to the charity. And if your financial institution tells you that they can't do it, either tell them yes they can or just don't do it, because you're
Yeah.
going to end up. I've seen
Yeah.
people get dinged.
Yeah. So what's happening if you take it yourself, then it's just a regular charitable contribution. And a lot of people, like years ago, when they probably 85% of the people used to itemize, but now that they raised the standard deduction so high, I think 85% of people don't itemize. So you gave the money to the charity, but you might not be able to deduct it because you're not able to itemize. So the other thing it does is also it lowers your AGI. So that'll also help. Maybe a little less Social Security gets taxed, maybe a little less of your state gets taxed. So if you can give it to the charity off the top, that would be that's preferable. But you got to do it by the end of the year. We're already in November, so if you want to do that, if you're one of our clients, call us. We can accommodate that. If you're not one of our clients, you should still call us. No, just kidding. So, but yeah, and just remember it has to be an IRA, because we've had clients try to do it through their 401k, and you're not allowed to do it that way. It has to be an IRA, which is another ridiculous rule. But that, I guess that's just the way it is. So
Well,
Right.
if you're
Yeah, you're
72, you should be able to take money from the 401, do a rollover to the IRA, and then take the money from the IRA as a
right, if you have enough
charitable.
time,
Yeah.
if you have enough time to do
Well,
it. But what happens is someone reads this on the internet and they just tell their 401k provider send money
Right.
to XYZ church, and that doesn't qualify. So
No. No, that's not good. So, speaking of stocks, though, and what about investments before the end of the year? Is there anything that
yeah,
people should be
so
thinking about there?
the stock markets are down, right? So
No, in 2020?
I don't think we've talked
Come on.
about that.
yeah. Well, the elections seem to not talk about it, but so stock
Yeah, that's
markets are
true.
down.
That's
So you could sell off some losers and also sell off some winners and offset the gains. So if you have some winners on the books and you want to not pay as much tax, then you can sell some of your losers and offset. So if you have the $10,000 gain on a stock and a $10,000 loss on another stock, you can offset those and you don't have to pay the tax. Now, there is this is kind of silly too. There's a thing called the wash sale rule. So if you sell a stock and then rebuy it 30 days later and it's a loss, so you have to exclude that loss. If it's a gain, you got to pay the tax. But if it's a loss, so so usually if you're with a financial institution, one of the brokerage houses, they'll code it on your tax return, or they'll code it on your 1099 to show if there's something called a wash sale. But just basically, it's preventing you from. I want to sell my IBM that's down and recognize the loss and then buy it back 2 days later. They won't let you do that. I mean, you can
And
do
you
it, but you just don't get the deduction
The maximum you can take as a loss is $3,000.
above what you
Above,
offset.
right,
So
what you
if
offset.
you, as Tony said, so let's say you sell $100,000 of gains and you have $120,000 of losses, you can offset the 100 against the 120 and you still have an extra 20, but you can only take 3,000 of the 20 and the rest carries over, which is ridiculous because that rule hasn't changed since that $3,000 number hasn't changed since I got out of college.
Wow.
I mean, back in I remember the tax law passing in 1986 because they actually passed on my birthday. So I remember that, and that number was 3,000 then.
Wow.
And I remember we had that big decline in 87. Remember, we had that stock market. Tony doesn't remember, but we had a stock market crash in 87.
Yep.
And being at one of the biggest accounting firms in the world, we have some pretty wealthy clients. So one client lost like $3 million on that day.
Wow.
So I'm like, somebody
That's
want
nuts.
to give them the phone call? They're like, what? Tell me you can only deduct $3,000.
Right.
He's like, what? Unless he has some winners to sell, he's never gonna get that money back. But
An interesting one too, if we're talking about end of the year and sales, I know we're getting up there in time, but if you have mutual funds in your portfolio that ordinarily by the end of the year, mutual funds will start making sales within, like, say, the month of December, they'll start selling off some winners. The problem people are running into this year, this is just in taxable accounts. So it's not your 401k or your IRA, it's in a taxable brokerage account. If you're starting to have some of these funds that have maybe been having some gains for years and they haven't sold anything and now they're selling, you're getting a tax bill on it and your account is down in value.
Right. So you're gonna get what we call taxable capital gain distributions. The other thing about if your account's down, you don't get to deduct it. You actually have to sell it. Like just because it dropped in value doesn't give you a deduction. You actually
Right.
So if IBM dropped from $100 to $50, you're down in money. But until you actually sell that stock, you can't take the loss. Right. So. All right, we're 26 minutes
Yeah,
into this.
we
so,
should wrap
wow.
it up. How can our
Okay.
listeners get a hold of you to go over their year-end financial checklist?
Look at that, Tony.
So you guys obviously visit us online, brooksidetax.com. You can schedule an appointment there. You could give us a call, 440-886-3550. Reference this podcast. Your consultation will cost you nothing. And you can pick up a copy of one of Dr. Anselmo's books on retirement and estate planning as well.
Okay. All right,
Awesome.
guys. We will see you next week. Happy 100th anniversary.
Yeah, nice 100th
Congratulations.
show. Yeah.
100th show. Wow.
Good job, Chris. And that does it for today's episode of The Road to Retirement with our hosts, Chris Anselmo and Tony Marlette Jr.
All right.